Have you ever watched a stock just go absolutely wild and then wondered, okay, so what happens after the hype dies down? Well, today, that's exactly what we're going to do. We're going to take apart a professional technical analysis report for a single, super volatile stock and see if the data can give us any clues about what might be coming next. So, why are we even talking about this company, Nuburu? It all kicks off with this one absolutely massive number, 163%. I mean, come on, that's the kind of move that gets everybody's attention.
And yeah, that wasn't over a year, or even a quarter. That gain happened in just 14 days. An absolutely explosive surge that took this stock from being basically unknown and put it right on every trader's radar. But you know, those rocket rides can't last forever, and the frenzy has definitely faded. So this is the perfect time for us to step in with a cool head and do some investigating. We're going to use this report to figure out what the data is telling us now, after the dust has settled. Is this thing just a memory, or is it maybe, just maybe, quietly building up for another launch?
So before we can look forward, we've got to understand just how we got here. Let's quickly trace the path of this stock's insane recent roller coaster ride. And it really is a classic roller coaster story. It all started back on September 26 at just over 12 cents. Then, bam, the explosion up to 85 cents on October 8th. But what goes up that fast? Well, it often comes down just as hard. It pulled back big time before finding its current level, kind of settling around 34 cents. It's that classic boom and bust pattern all crammed into just a few weeks.
Okay, so that's the backstory. Now let's shift gears and focus on right now. We're going to take a snapshot of the stock's vital signs, according to this report, to get a really clear picture of where things stand today.
So here's our source document, a technical analysis report using data from October 18th. The number that really matters here is the closing price, 34 cents. That single data point is the anchor for all the analysis we're about to dive into.
So, the report crunches all the different data points and spits out this one number, an overall technical score of 60.13. Now what the heck does that mean? Well, the report calls this a bullish bias. So even after that huge drop from the highs, the underlying data is actually still leaning positive. Interesting.
This slide right here, it perfectly maps out the current battlefield. Think of it like this. There's a ceiling at about 36 cents. That's resistance. Then there's a floor down at 31 cents. That's support. And right in the middle, you have the pivot point. The entire tug of war between the buyers and the sellers is happening right between these three levels. All right, now for the really fun part. We're going to go full-on detective mode. We're going to dig into all the individual indicators from the report, the clues if you will, to really understand why the report is leaning bullish even though the stock has dropped so much recently.
So our first and honestly most important question is all about the trend. I mean, after a move that violent, both up and down, is the main uptrend still alive, or has it been completely broken? Let's see what the data has to say.
Okay, this right here is a key piece of evidence. The ADX, which is short for Average Directional Index, basically just measures how strong a trend is. Anything over 25 is considered strong. So at 36.69, this indicator is pretty much screaming that the market's underlying belief in that uptrend, the very story that kicked off this whole move, is still very much intact.
But hold on, it's a little more complicated than that. Here's where the tension comes in. The good news is the price is holding above those important medium-term averages, which is a great sign for the health of the overall trend. But the bad news? It's recently slipped below the super short-term 5-day average, which tells us the momentum has kind of run out of gas for now.
Okay, so the trend is strong, but it's tired. That leads us right to our next clue. Let's dig into the momentum. We need to know about the speed and the force behind these price moves. Is the engine still running hot, or is it starting to stall out?
And here we go again with a conflicting story. On one hand, you've got that insane rate of change, our plus 163% number, which just shows the sheer, raw power of that initial blast-off. But on the other hand, other, more sensitive indicators are now negative, hinting at a slowdown. It's like a car that went from 0 to 60 in 3 seconds, but now the driver has taken their foot off the gas.
Now this is where the story gets really compelling. After that huge pullback, several key indicators are flashing oversold. Think of it like a stretched rubber band. The price has been pulled down so far, so fast, that it might be due for a sharp snapback. One of these indicators, the Stochk RSI, is at an incredibly low 2.91, which suggests the sellers might have finally just run out of steam.
Okay, so we've got our clues laid out. A strong underlying trend, some fading short-term momentum, and these oversold conditions. Let's see how the analyst puts all of this together to come up with a final recommendation.
So the verdict basically comes in two parts. For the immediate short term, like the next week or two, the call is to hold. But if you look out a little further over the next 1 to 3 months, the outlook actually shifts to mildly bullish. Let's break down why.
So the short-term hold call is based on those oversold indicators we just saw. The analyst thinks the selling is probably done and that the price is going to stabilize around that support level we identified. But, and this is super important, hold does not mean buy. The report is very clear, warning against jumping in until there's a real sign of renewed buying interest, like a big spike in volume.
So why does the outlook get a little better over the medium term? Well, it all goes back to our very first clue, that strong underlying trend measured by the ADX. The analyst basically believes that as long as that trend conviction holds up, the explosive power we saw in that first rally gives it the potential to eventually make another move, maybe even targeting that 47-cent level.
But, and this is a huge but, the report is crystal clear about the risks. The volume, the amount of trading, has been dropping off since the peak, and that is a major red flag. The stock is also incredibly volatile, and let's just be honest, it's a penny stock. And that whole category of stocks just comes with a much, much higher level of risk than your average blue chip company.
So after all of that, the bull case, the bear case, and the final verdict, let's just zoom out for a second. What's the single biggest lesson we can take away from all this?
You know, it's funny, but maybe the most important sentence in this entire report is the one buried in its own disclaimer. It reminds us that this is purely a technical analysis. It's only looking at charts and data, not the company's actual business. Not its revenue, not its debt, not its products. Technical analysis is just one piece of a much bigger puzzle.
And that really leaves us with the final question, doesn't it? When you look at a stock like this, with its explosive chart but all its significant risks, what are you really seeing? Is it a calculated, speculative play where the data gives you a bit of an edge? Or, without knowing anything about the actual business, is it just a roll of the dice? The data can give us clues, for sure, but it definitely doesn't give us all the answers.